Latest episode of Quest for Twice. Today is April 12th. I'm going to do a deep dive on Meta platforms, formerly known as Facebook. The Facebook products people are generally familiar with, which is a social network platform. So Meta platforms had 97% of revenue from advertisement in 2021. This graph shows the revenue in bars in the last 12 years. I also plotted the sales growth year on year. That's the purple line. So you can see a growth deceleration from over 50% to less than 30% in 2019 and 2020 before a rebound to about 37% in 2021. The rebound in 2021 was most likely due to the impact of a pandemic and more people went online, spend more time online, and small businesses switch to online advertisement. So for Meta platforms, there is a flywheel effect of content creators, users, and advertisers. They attract each other to this platform and generate revenue growth for Meta platforms. A remarkable thing about the Meta platform is its high gross margin shown in this chart, the blue line. So it always hovers around 80%, which is very high, despite the very large size of Meta platforms. So in Q1 this year, the Meta platform stock price declined 35%, mostly because the Q4 earning reports happened in Q1. The management gave a outlook of 3 to 11% growth in Q1 2022. And that's a very significant reduction from the historical growth trend. So its stock price was severely punished. So a good way to look at the Meta platform revenue is to think about the user monetization. So the growth is driven by user growth and impression growth. In these two bar charts shows the Facebook daily active users in the last 9 quarters, as well as family daily active people in the last 9 quarters. So we can see that the user numbers have plateaued and even slight decline in Q4 2021 compared to the previous quarter. This partially explains the slower revenue growth trajectory. The main reason behind it is a very stiff competition from TikTok. That's a short video platform, getting a lot of people to spend time on TikTok. Facebook responded with its own video service called Reels. However, so far it's getting lower ads price from short videos compared to other forms of advertisement. The third reason is users spend less time online with the economy reopening. However, there is another side to the coin of revenue growth, which is revenue per user. For Facebook, we can see that for worldwide in the last 5 quarters, there is a clear trend of revenue per user growing, and that's also consistent across different regions from North America, Europe, to Asia Pacific and the rest of the world. It's also very interesting to note that the revenue per user is strongly correlated with the regional wealth, i.e. GDP per capita. So the rest of the world user revenue is only 5% of US Canada revenue per user. Facebook also noted a significant impact from the new Apple iOS privacy policy makes Facebook harder to reach a target audience. Then there'll be less clicks on Facebook ads and getting lower return on those ads. So will the Facebook growth continue in the years ahead? I like to look at the return on invested capital. So the chart on the right shows the Facebook ROIC comparing to Amazon, Google, and Microsoft. It's pretty amazing to see Facebook had an extremely high ROIC compared to the other three tech titans. And the return rate, although moderated slightly in the recent 2-3 years, but it is still comfortably higher than the other three tech titans. On the other side of this coin, we see that on the left shows the total invested capital for big tech giants. Facebook is the red bar. So the total invested capital is much smaller than the ones from the other three companies. So the takeaway is Facebook has a very high return on invested capital, but it does not make as much investment as the other tech giants. Now let's take a look at the valuations of Facebook stock. Using my favorite metric for growth companies, I plotted the EV over gross income for Facebook stock in the last 11 years. Currently at $220 per share, that ratio is 6. That is significantly lower than the historical range from 7 to 20. So I would argue that it may not be the right metric to evaluate Facebook, because now Facebook it can be viewed as a value stock. The reason I say that is because the enterprise value over EBITDA now is about 11, and the forward PE is about 17. And another very important metric is cash flow yield. That's about 9%, despite the investment in R&D, including Metaverse. In the last 2 years, the cash from operations was 58 billion in 2021 and 39 billion in 2020. And Facebook spent about 20 to 22 billion dollars each year in last 2 years. So there is a very large free cash flow after investing in R&D as well as capital equipment and mergers and acquisitions. So with the current low valuation metrics, the market is forecasting negative growth and is ignoring multiple growth opportunities, including Facebook revenue growth outside the US and Canada. And also WhatsApp is not currently monetized. So there is a growth opportunity there to monetize, and also Metaverse, of course. So if I conservatively say Facebook enterprise value over gross income should go back to 8, which is lower than the historical range for most years except 2018. Then the Facebook stock price should be about $300 per share. So I would like to summarize my investment thesis and the risks. So Facebook slash Meta platform is a growth company priced as a value stock. It has a wide moat from strong network effects, which will ensure its durable future advertising revenue. It has a track record of a high return on invested capital. Its focus in 2022 includes Reels, which competes with TikTok, community messaging, business messaging, e-commerce, targeted ads, privacy, artificial intelligence, and Metaverse. So there is no shortage of investment opportunity. and based on its track record of a high return on investment, its future revenue and profit should continue, driven by investments. So what are the threats and opportunities? The green ones are the opportunities, include stronger monetization of short videos and the secular growth of advertising online, especially outside the US, driven simply by GDP growth and more people outside US to go online, spend more time online and doing e-commerce. Also, I mentioned earlier, there are opportunities to monetize WhatsApp and the metaverse eventually. However, the opportunities need to be balanced with the threats. The top one is TikTok, which is large and growing fast despite its large size. So it's quite a formidable competitor to Facebook. Another one is a loss of goodwill due to the shady privacy practices Facebook adopted in the past, which may lead to loss of users, or users simply spend less time on Facebook platforms. Lastly, there is always a chance that the metaverse will not really become something useful in people's daily lives, even in the future. So all the investment the Facebook Meta platform is making will get wasted. My takeaway is at the current stock price, the threats are overemphasized and the opportunities are not reflected. So I think there is more upside than downside in Meta platform stock. I plan to increase my position when stock market pulls back. So this concludes the current episode of Quest for Twice. Until next time, happy investing.